Welcome to the Maverick Retirement Podcast. This is a place to hear on how to achieve financial success and live an incredible life in retirement. I am Robert Cannon, author, educator, and CEO of Cannon Wealth Solutions, your host for this podcast. So today we're going to talk about something very exciting. Usually when I have my client meetings and we talk about pre-IPOs, the client's eyes get super big and they're super excited and they want to participate. So today I have Richard Berman, securities attorney, many years structuring these type of transactions. And Richard, tell us a little bit about yourself.
Absolutely. So, Robert, as you mentioned, I have a background in securities law. Following law school, I went to work for one of those big Wall Street law firms, practiced in the hedge fund space. And when you practice in the hedge fund and private equity space, you automatically become involved with alternative investments and getting to know the entire gamut of these things. So over the course of my career, on and off, I've done work not only structuring the alternative investment funds and private equity funds that do these kinds of investments, including investments in privately held companies, but also in understanding structuring the actual transactions and the processes that go into doing those transactions and picking up these assets. I've done deals involving real estate. I've done deals involving privately traded securities. And obviously with you, I've got a very good history going back a few years where we've worked together on some very interesting deals. I think the first one that we may have done, Facebook comes to mind, Twitter comes to mind, Lyft comes to mind, Nutanix is another unicorn that went public very successfully. And most recently, obviously, you've done an artificial intelligence company, ThoughtSpot, and you guys have also done SoFi, which just recently announced that it's going public. So in addition to wearing my securities hat, I'm also an investor. I'm deeply involved in alternative investments. I'm presently the chief operating officer of a litigation finance company, which is yet another non-correlated alternative investment product. So I'm trying to help build out a platform there that's hopefully going to successfully exit one day. But the pre-IPO space, Robert, going back several years, I remember you and your partner, we had a conversation. How long is this going to last?
Exactly.
We are in 2021, and the IPO market and bringing new companies and disruptive companies to market, it's still a big deal.
You forgot
one. Be like this?
You forgot one company which is like the thorn inside me, Roku. You forgot Roku.
Oh. So we're going to talk about that a little bit, but one of the you are never happy when it comes to the pre-IPO, post-IPO market. This is the one investment where you simply never know. Roku is a perfect example. I remember working with you guys on a couple of rounds, actually, and I will never, ever forget. Part of my job for you guys was to help you set up your structure, right? The idea of investing in privately held companies, it has many different components, but the most important component, obviously, is economy of scale. I, as an individual investor, you yourself are one or two people, unless we are super high net worth individuals, we're simply not going to be able to execute a transaction in the private market for one of two reasons. Number one, sometimes the people who are selling shares of their private unicorn companies are selling so much of it over a period of time that a single buyer doesn't pick it up. It may not even make sense for a single buyer to pick it up because you're just all in on one company. But also because just the sheer size of the transaction, not everybody has that kind of spare money and the kind of disposable income that they don't need liquidity in the next year or so to be able to do it. So the idea is to put together these private investment partnerships, and they're pretty much like mini funds, right? And sometimes they may involve more than one opportunity. Sometimes they're focused on a single opportunity. So in a way, you're using a special purpose vehicle to get into a stock. and you guys arrange that and you organize that and you source the deals. I remember on Roku, part of my job obviously is to let every single investor know this comes with risk. And besides all the boilerplate risk factors, one of the things I remember writing about Roku was this is like the most ultra competitive space there is. Here is a company that is trying to execute a strategy that's digital, that's based on technology, more so than on hardware, more so than on, putting something in. It's not a television company, right? And immediately, the bells and whistles are going off. Is this a hardware company? Because you don't want to be there. Remember, Sony speakers are gone. But we said, listen, this company has some bold plans. They've got some amazing technologies that clearly point to potential market dominance at some point. Whoever knew Roku was going to take off like that? And the crazy part is, it was one of the most wildly successful investments you guys did. But here's the problem: now it's on the stock market. When do you cash out? You've taken all this risk. You're so happy there was an IPO. You held it for 6 months, and I will go into that a little bit. But now, when do you let it go? And you never let it go at the right time. And I always call you every day, and I tell you that Roku's trading at 402, 417. What did you guys get it for at the beginning?
$6 initially. So $6. The very first tranche was $6, and I think now what did you say is 400? I refuse to look anymore because it keeps
$414 was the last time I pestered you about it. So I mean,
oh my God,
isn't that crazy?
I refuse to look. It's just
sometimes you're right about a company you want to buy. You don't know how right you are. Correct? That's the most frustrating thing about investing. However, on the pre-IPO side, I think the opportunities to invest in companies before they go public is a maturing investment class. It's an investment class that has been showing that it has longevity. It's survived different market cycles, some market corrections, some bad IPO markets. But it isn't going anywhere. And I feel comfortable saying that a few years ago, we thought that this is a short-term type of thing. At some point, it cannot possibly last, and it has lasted, and it has become actually more varied. It's more challenging now. There's so many companies now to choose from. So it's something that's going to stick around, and it's going to stick around primarily because private companies can stay private longer and don't have to go to public. Uber is the best example, right? Here was a company that was worth over $50 billion, at least on paper. Those companies years ago, not only were they public companies, they were already public companies for decades. And yet the private capital markets are so much different than they were 20 years ago when I first started out in the securities business. And also, one of the unique things about the pre-IPO business is that you have all these regulatory changes that also came about. It started off in the Obama administration. They passed the Jobs Act. It became easier for private companies to raise money. It became easier for private companies then to go public. So the pressure of going public is not the same as it used to be. There are various ways that some of these billion-dollar companies can be listed. So, for example, confidential filings of registration statements, something that was unheard of before. And that is something that's happening today. So this comfort level that these companies have says, we're going to stay private. We're going to build our business. We're going to build our brand. We're not going to take on the responsibility of being a public company until such time as we can dedicate enough resources to that. Meanwhile, let's go about the business of building a brand, bringing in more users, engaging more consumers, disrupting a technology. And so as an alternative investment class, this is one of the most unique and interesting types of investments. It is one that is perfectly built for the investor who says, I don't need this money for any period of time. It only represents a certain amount of my net worth, but I have certain goals and I have to earn a certain return on my total investments. And there's only so much that you could make in public equities. There's only so much you could earn in real estate or anything else. And forget fixed income. I mean, they just don't want us to invest our money in anything that, I mean, you understand, right? So this is a very interesting component. But I think the biggest component is you got to pick the right team, the right people who understand how to pick these stocks. And I have a question for you, Robert. Right now, I'm sure you have many more companies to choose from than when we first started out in terms of, what was going on. There are employees and mid-level executives of all of these unicorns who say, I need $5 million, so I'm going to go sell my shares privately. What are you looking at right now to differentiate among the tons of companies that you're looking at?
It's very difficult. As you know, with SoFi, which we spoke privately about, and the idea of them having that foundation of a SaaS where Robinhood, which everybody heard of Robinhood, is using their foundation to open up accounts. So we're here to stay, obviously, in SoFi. And that's where the real value is. So also the front end of SoFi and the customer base, right, that they're accumulating, obviously that's why we invested in. And it's nice to see that the public markets and Chatma, believes, in what we saw a few years ago in SoFi. So, like you said, the methodology in picking these things is difficult. I want you to talk a little bit about, let's just take us out of the equation. If someone is looking for pre-IPOs, what are some of the pitfalls in addition to just picking the right one? What are some of the pitfalls in terms of structure, buying, as you know, in Facebook, there was a lot of fake shares out there, things like that. What are some of the pitfalls that people can
first things first, you got to pick the right team, as I mentioned, because they have to not only be able to pick the right companies at the right valuations and tune out some of the noise. You also have to be willing and able to work with people that you have respect for, because a lot of times what's going to happen is, and I saw this, hey, why are you not buying this company? It's so popular. Everybody knows about it. And then it's your job to come in there and say, because right now they're being valued a multiple of X times 20 years future earnings. Why am I paying for it? Right?
Exactly.
Paying for it. So that's the most important element of it. The other thing that I would recommend is for people to understand that the structure of the investment that you're in is extremely important. As I said, not all partnerships are born equal. Sorry, just a moment.
It happens, especially we work at home. Okay, we're back. So continue.
Well, the structure is extremely important on these deals. The most important thing is you have to know the investment terms that the investment manager who is getting you into these private deals is offering. You want a fee structure that aligns interests of both parties. You don't want it to be a strict fee-based business. There's a lot of that out there. There's an auction market for private shares. You also have to look at the type of deal execution that your manager is going to give you. Are these shares being bought overvalued? Are they being bought at a discount? So all of that is part of the expertise and also the fee structure. That's extremely important. You want the manager to have an incentive for a successful deal after a certain hurdle is met or other ways, but the incentive has to be there. That's one important aspect of it. The other one also is you have to make sure that you're in a deal structure in which the manager explains to you the process of purchasing shares from a company that is not yet public. What happens is typically as follows. You got these companies in Silicon Valley. You have a lot of young employees, mid-level people, sometimes executive level people. A lot of the compensation structure in these companies involves the shares of the company. As these companies grow, they're doing financing rounds. Everybody knows what's going on. They know what the value of the company is. They look at their shares. They look at the options that they have. They look at some of the securities they hold that are convertible into shares and say, wow, my shares are worth $30 million. Now, they know that they can't access $30 million right away. However, they need the money for one, they're trying to finance a certain kind of lifestyle. They want to make a purchase. They want to do whatever it is. Some of them do have the ability to go to their company and say, can I get some liquidity? And the companies allow it. And that's a typical example. It's not in every single instance. That's not how the shares are obtained, but that's the process. So now in that process, you have to then be able to put together a deal in which you tell the investor, we may or we may not be able to obtain the stock from these people at the right price. We're going to enter into negotiation. We're going to raise some money because we have to have money in hand, right? So you need proof of funds. So if you get into one of these partnerships, you have to be ready to actually subscribe and to pay to enter into the partnership before the stock is held. But here's where disclosure and the right terms are extremely important. Some partnership structures say, we're going to hold your money, indiscriminately, right? A year or 2 years. We're going to be looking for an opportunity. Well, unless you really want to work with someone like that, I think that's the wrong structure. You have disclosures that say, we are going to execute a deal in this amount of time. If we can't, here's your money, and we'll see if we can find another deal at some other time. So that's an important part of it. And the other important part of it is you have to explain to the investors there's a ROFR process. A lot of these companies have a right of first refusal to buy the shares at the same price from their employee. And so you have to go through that process as well. All these things have to be disclosed to the investor. There are restrictions on privately held shares that are very important that you have to abide by. Just because the company went public on Monday doesn't mean you can to sell your shares. Typically, IPO shares have a 6-month restriction on them. So you have to wait 180 days. You have to look at the structure of the deal that you're in. What happens at the end of the 180-day restriction period? What kind of communications are you going to have with the management team? How much discretion do they have? Now, those are give and take matters, right? In some instances, you want your manager to have discretion because he's sitting there and saying to yourself, look, when the lockup expiration occurs, there could be some volatility. You don't have to force me to sell it on that day. I'm going to get the best execution, the best price for it. But you have to be able to be upfront. All those things have to be spelled out. It's a process. So that's the important part of the structure. But understanding the regulation, you're buying privately held shares. You're not buying them directly. You're buying them indirectly via a partnership, a private partnership, which in and of itself is a privately held security. So the team, the reliability, the ability to execute, a track record, right, are all important things. You mentioned we were doing Facebook and Twitter. The stories about non-existent shares, yeah. And I'm not going to talk about the guys that went into the business with bad intentions. Right. Easiest conversation to have.
That's going to happen no matter what.
Right. I want to talk about the guys who had all the good intentions, but really they just had no idea how to execute a deal, how to vet the deal and say, am I really buying Facebook shares?
They got duped.
Sometimes they would have to buy the shares indirectly themselves. Now, that is not necessarily a bad thing. Sometimes there's no other way. Sometimes your partnership has to find another partnership that has it, and they need for you to contribute some money towards their partnership. But you have to be able to vet them, their track record. Do they truly own it? And we've looked at deal docs together. When you finally get a share purchase agreement, I look at it, I call you back and I say, everything looks good. You're going to be able to sell common stock. It's fine. There's a 180-day lockup period. There's no boogeyman in any of these documents. It's owned. I actually remember us calling the law firm.
I was going to mention, in addition to that, we also spoke to the law firm. And if you remember in Facebook, one of the founders, and in times one of the founders, but the law firm as you know, was a really big law firm. So
Fenwick.
yeah, these guys are paying like.
And the other one I called was Cooley, and they're big in the venture space.
Right, exactly. So obviously, we have our due diligence process, and we have our contacts that we make sure, and you're speaking directly to the attorneys over there.
Absolutely.
We have a better process, but
absolutely. And more, and obviously the right management team is also going to be able to access the deals that you want to be in. And at the end of the day, it's just having that network of intermediaries who arrange for these types of transactions, who themselves are reliable. You have to know your price. And sometimes it's important to work with somebody who also knows how to say no.
Right.
And say, too much, right? And so all those things are extremely important. And finally, I think an informed investor is the best investor in these types of in these situations. You also want to be able to put a mix of investors together who all have the same interests and who are looking to gain liquidity at some point. Now, it's another very important thing. Because this is an alternative investment, it is not a liquid investment. It should not be considered a liquid investment. What's unique about it, and what I find completely fascinating is that this is a niche. This is not venture capital investing, because for the average guy, 5 to 7 years, none of us want to wait 5 to 7 years to be able to hold, money in hand. So you're looking at companies that you believe, for one reason or other, are on the cusp of going public, that they're maybe 1 year away from announcing an IPO, maybe even a year and a half away, sometimes even faster, or they'll surprise you. But you still have to understand that all in all, you're holding in a liquid investment. And those are the kinds of things that the structure is built for. It's really built as a true alternative investment. It's not like a hedge fund, which is an alternative investment. Most hedge funds that invest in publicly traded stocks, they tend to have liquidity. You can withdraw money every quarter, every half a year, depending on the circumstances. I think some of those funds also actually do this kind of niche investing. It may not be pre-IPO stocks, but they tend to put those in a different basket called a side pocket, right? So just imagine that these investment structures are side pockets. They're unique side pocket investments that will be liquidated once the actual underlying stock is itself liquid. But
I want you to focus on, let's talk a little bit about, because you touched on it a little bit, our niche and what we focus on in our methodology is more late stage companies. So like you said, we're looking for something that's going to go public in, 1 to 2 years. That's basically right there. Let's talk a little bit about the Series A, Series B. There's other stages. Let's elaborate on that so the public could understand a little bit the phases.
I mean, most of us that know business, we typically know business where you're building out a restaurant or a small hotel. Some of the most complicated structures may simply involve 5 or 6 people getting together, partnership. Maybe they go to a lender, and they try to deal with banks and so on and so forth to try to build out a business to scale. The types of businesses that we're looking at are more, the way that they grow is a little bit different from your typical bricks and mortar business that you have. And the reason is that they are not looking to stay small businesses, right? So when you hear words like Series A, Series B, these are business concepts and business ideas where the desire is to build scale or disruption. And so the type of investors that you're attracting are the ones that are looking to make it big, for the company to actually go public one day and to become that big. And it's very, very different. So the earliest stage of investment into these types of new startups, let's just imagine, 3 juniors at Yale right now are sitting around and thinking up this incredible thing. You got the computer science guy, you got the drama guy, they're all in, and they cook up a startup. And you know what? It may have some traction. It won a couple of competitions. They went to a couple of business incubators that are interested in them. So the earliest rounds are called angel rounds. There are actual professional investors out there that call themselves angel investors. These are the earliest guys in. They usually get the most favorable deals. They don't necessarily invest the most amount of money, but they're investing money at the most desperate time for these guys. They're the ones that are saying, I'm actually willing to take a chance on this crazy idea that you guys are working on because I think you have something here, right? And we're assuming, obviously, that your starters or your founders are not people who have started other companies before, because that's a little bit different. And then what happens is, if this company stays in business and delivers, I think, what I call a proof of concept, and then can go from proof of concept to actual product formation or distribution, and so on and so forth, and then build a channel and acceptance and all these steps, they become funded in series of rounds of investment. And what happens is that the investor audience with each round changes. After your angel rounds, now you start seeing some of those early to somewhat mid-stage venture capital investors that are coming in. So you have the Series A and you have Series B rounds and Series C rounds. Oftentimes, before these companies go public, they may be doing a Series D. I think we've seen an E series right before a company goes public, right? And slowly but surely, different players start coming into the ball game. You got your early stage venture guys that may be doing the Bs. You got some of your angel investors that may be doing part of the A. Some new groups come in. Some of the private equity guys may be coming in later and doing different kinds of financings. It may not necessarily be equity financing at that time. And a lot of times the early investors are the ones that go in there and they'll invest in the B and then the C and then the D. One of the things that we find interesting when we're looking at the history of some of these companies is to see how often the same guys are adding to the round, but we're also looking at whether or not new players are coming in to finance these companies. And sometimes the new players come from exotic places. At the Series D round, you may get the Qatar Investment Authority coming in and saying, here's $500 million, as long as Sequoia is also doing the next round, and so on and so forth. So these venture capital and private equity investment companies are making big, big bets with each round. And in each round, these companies get a valuation. And the valuations in most instances are based sometimes on revenue, but they're also based on acquisition of user. I mean, Facebook, it was all about how many people are on your platform, because the idea was, we're not worried about monetization. We know they will monetize this at some point because they look like an advertising platform. And so all of these different rounds have a different investor audience. And some of the earlier players those are deals that are done by private equity companies. And so if you are an investor and you are invested in a venture capital fund, for example, you should expect that the venture capital fund is going to be going out there and making some of these early stage investments. And you're going to have a much longer holding period in order to be able to earn X amount of return. And those venture capital funds are making investments across a wide spectrum. They're not going to do very well on most of them, but they're looking to make one or two deals go public, like SoFi is going to be going public, or like Nutanix went public, or like Twitter eventually went public.
They're obviously getting a much better price than we got in.
Oh, forget it. Exactly. But again, they're getting a better price. They're taking a bigger risk.
Right.
And they're also investing in a way where they may have to double down on their investment. So in a way, they've got a ton more skin in the game. And oftentimes, a lot of these investment companies are structured not only as funds. It's not like just fund manager, and chief investment officer. Oftentimes, they basically have to give to these companies a value proposition. They have to say to them, look, I'm in this space. Let's say if it's fintech, they could come to this company and say, I've already taken some other fintech companies towards an IPO. I have all the networks. I know who you need to talk to. I can help you. I can bring teams. So they oftentimes bring money plus the value add, and that's a very important thing. And they tend to do better than the ones that don't. So that's also important. Some just come in for the money, like the Qatar Investment Authority. They're not there to help you build your business. By the time they're there, you have a business. You're just a bridge to an IPO. And here's another important thing. I know we've been concentrating on IPOs. Most of these companies don't go public, by the way, right?
Yes.
The successful ones I'm talking about. Most of the successful companies get acquired.
Exactly.
Out by a larger company. Someone who believes, if I allow this company to get too big, they may be a competitor. That's one way. Or someone who could say, you know what? I wanted to build what they're building. We just didn't have the bandwidth. They did it, so I might as well acquire them because I was looking to do that. And they did it for me, and I'm willing to pay a handsome price for that. And a lot of these early stage investors are more than happy to see an acquisition take place. So it's not always about going public. But obviously, we concentrate on the IPO stories because they're the ones that CNBC and Fox Business News are talking about when they pop 106% on the day of the IPO. So that's what everyone focuses on. But a lot of these things happen behind the scenes in an acquisition where these early stage investors are very, very happy with the result.
I'm glad you mentioned that because a lot of people are under the impression, you put in 10 grand and it's worth $1 million. I mean, that's a different type of investment. I would say the late stage is more, what would you say, 1 to 10x maybe late stage? Well, in this market now, I would say 1 to 10. Obviously, Roku was a outlier, but I would say maybe 10.
Right. You have to step back, maybe because with my history as a lawyer and looking at these transactions from above, sort of hovering and understanding how they've happened, it gives us a different kind of insight, right? We don't focus on one deal to figure out what you're looking for. You're definitely looking for an outsized return when you're investing in it as a pre-IPO, because the thesis behind the investment, the best thesis behind the investment is I'm getting this company right now at a valuation that no other investor will see in the public markets.
Right.
The way I look at it is you've done well in a pre-IPO side of things. There's 2 factors playing here, price and time. On the price, if you get a valuation for your company that the public markets never see, that doesn't happen even if the stock dips at any point in time, then you're a winner. Your cost basis in this company is as good as it could possibly be without having been Sequoia or Andreessen Horowitz or any of these other early stage guys. And that's fantastic. That's amazing. So you got all these people who are high net worth individuals who were never able to do that. And now they're getting the cost basis that is not as good as the private equity guys, but right in between. So to me, what that return is at the end, well, that doesn't matter. As long as I did better than anybody could have done post-IPO, I already think you won. Now, the second factor obviously is time, right? And you're hoping not to have a very large holding period. But if you do, you're hoping that the multiple that you're on your investment more than pays for it. So you're looking to beat the markets in essence. But
like you said,
10,000, 1 million, no, because we're not taking that risk.
Right.
When you guys are looking at a company, you guys are not looking at companies that, listen, again, everything is with risk, and even late stage companies can fall flat on their face. It happens, right? In fact, there are some interesting risks associated with late stage companies, because in the world of Silicon Valley, what you often see is, they love the unicorn at $1 billion, but then they're looking at this company that's been hovering around $6-7 billion valuation. Then they're like, what do you have to offer? It's like, so there are some, and obviously with technology, someone else could come along and deliver the product better, faster, and you're gone, right? So there is risk, but typically you're looking at companies already when in that pre-IPO stage. they've got things down. They're doing it right. And now, this is the part that gets me now. Now, a lot of these companies are brand names. Look at Airbnb, right?
Right.
Didn't have to go public for people to know what Airbnb. I remember the days when going public was the first time people found out about a company.
Right. Exactly.
Forget it. Now it's like, when is Airbnb going public?
Right. Exactly.
So, right. So are you gonna be able to buy Airbnb before it goes public and turn 10,000 into $1 million within the next year or two? Of course not.
Right.
Of course not. It's been value. People understand the value proposition. It's not, and by the way, valuations, I mean, I remember like when I first got started in big law, was right around the time when we had that big .com, the bursting, right? I think things are different right now. I think there is room for error, but I don't think that the investment world views these companies and it's hard to throw one past them, really. They'll see a company if it's worth something, and they'll also be able to point out when a company is not necessarily the best play. Look, again, a lot of what happens with these companies is mostly post-IPO. There's a lot of room for growth for these companies post-IPO. Look at Roku. I know. It's like, so it's almost like Roku is a startup that went public, stayed a startup, and is growing exponentially. That those things are happening. That's why I think an investor who's thinking about this should be thinking about, it's great for me to get a pop from the IPO, but is this a company I would want to stay invested in?
Very, very
stay invested in this company. Wow, that was great. I got a cost basis by going into this partnership I would have never gotten otherwise. That to me is how you have to think about it, right? So 1 to 10x, up to 10x, yeah, absolutely. But if you earn 2x, if you earn 1.5x in the right period of time, and you hold on, and it's still a company of the future, you're ahead of the game. You're ahead of most people.
And like you said, realistically, you can lose all your money. Like, we obviously are very cautious to make sure that we're looking for things that we don't believe that's going to happen. But as you know, and you put in disclaimers in there, anything can happen. Like you said with Roku, like realistically, I mean, they had open API, they had open architecture. I mean, this was a company where Apple had, strictly proprietary shows, and Roku is like, guess what? Whatever you want, we'll allow you to have access to. Scary, but guess what?
It worked, exactly. And that's the other thing. Legally, this presents a challenge more so than on the hedge fund side.
Right.
I obviously have seen hedge fund managers just do things that, God forbid, like, what are you doing? Right.
Right.
They'll come in, and one of the biggest legal issues that when you represent a fund manager is they present the investment thesis one way, and then the execution contains almost nothing that's in the investment thesis, or they veer off away from the investment thesis, whether it's through leverage.
Different investments. Yeah, that's
right. A lot of the hedge funds are saying that they're going to be able to minimize the downside risk by doing X, Y, and Z. Then you open up these portfolios when they're doing the postmortem on these companies, and they're long only funds, right?
Right.
They're sitting there thinking, well, if you're a long only fund, I could have sat there and done the same thing myself.
Exactly.
I could have lost the money without paying the fee.
Paying the fee, exactly.
Right. But for the most part, when people invest with responsible managers, those managers are either going to make a certain amount incremental value for them on the positive side, or they'll go slightly negative. That's really where most of the performance is, right? And then the investor gets to think about whether or not they want to continue to pay the fees in this particular structure. That's that, and that's the basket of risk that I have to worry about. With this, it's actually very unique, because with this, what you're saying to the investor, and this is very important, is we really have to look at whether or not people are investing too much of their net worth into something like a pre-IPO investment. This is meant to This is the best investment for somebody who says, I'm going to allocate a certain amount of money because if I lose it, that's fine.
You go to zero. Exactly.
It's okay. And by the way, the opportunity is there because sometimes what you could do is you could do deals where you could build with some scale. And when you build with some scale, the minimums, the investment minimums don't have to be too high. So again, it's open to there's a lot of democratization here that's going on. You have lower minimums so that people don't have to invest a huge amount of their net worth. And they already have to have a certain amount of net worth being an accredited. This is an investment for accredited investors. And the definition under the Securities Act pretty much is you're either making $200,000 a year for the last couple of years, or you have $1 million in net worth. And the only little wrinkle that they added to this was that if you have a mortgage, you got to deduct the mortgage from your net worth. But long story short, an accredited investor is putting up $50,000, for example, to do pre-IPO investment. That is money that they probably can risk. It's very different from, but obviously this is not somebody who has,
100 grand and they're putting in 25.
Exactly. That's not what it's for. And I think the process of investing in pre-IPOs should not be one where you're sweating it out. It should be one that you're enjoying. It should be one that you're saying to yourself, I believe in the thesis of this company. I believe in this manager and I like this company. I think that makes sense. Now, in some instances, you may have to rely on the expertise of others because I don't know how many people in the investing public, people like myself, are sitting down and asking themselves, which of the artificial intelligence companies should I be invested in? But they know instinctively that, yeah, I got to be in artificial intelligence. You understand what I'm saying? So give yourself to a good manager with whom you could have that conversation. Make sure the deals are there. Make sure all the risks of the investment are properly disclosed to you. Anyone who's disclosing things to you, that means that they're institutional in quality. I think that's how I look at it. If I see something that's institutional quality, I know that they're looking to execute and ask questions. Right? You ask questions. Are you getting the shares directly? Are you getting the shares through a broker? Are you getting the shares through another investment partnership because they're simply not available? And those are the kinds of questions and answers. And by the way, that's one of the risk factors, right, that we put in.
Common shares, preferred shares.
Yeah, I may not be able to get it from directly from the seller. I may have to find other ways to get it. So I have to vet those deals as well. There's maybe some risks associated with that. But going back to
contracts, right? That's additional risk with forward contracts, things like that.
Absolutely.
Airbnb had a lot of forward contracts. So, I mean, we went over a lot. I think people will probably ask me for, different questions, and I can bring you back on and we can just go over some of those questions that they have. I think we gave a good broad view of, the pre-IPO business and what's out there, and, not to paint a picture that is some, guaranteed investment by any means. There's a lot of risk and you have to really have the means to invest and understand the risks. So, I thought that was important based off, my client meetings, and people, eyes are wide open and they want to invest so much money in these things when they see, hey, this Apple went up 5 million%, whatever it is. And, that's just not the average pre-IPO. So really appreciate, you shedding some light on the risk factors and how these things work. And I'm sure I'm going to have you on this and many other things because you're well versed in a lot of things, Richard. So again, thank you very much. And
thank you.
If you have any questions, please reach out to us, and we're willing to come back and talk more about this.
Absolutely, we will. Thanks. I appreciate it.
All right, you too. Take care.
Thank you for listening. If you loved the episode, please go to iTunes, rate and subscribe. And don't forget to join us next week for a brand new episode. Thank you.